Okay, so this is the part of the lecture where we're going to try to connect the balance between what we're making and consuming domestically and what we're importing and exporting internationally, right? So if our current account is balanced, if we're exporting exactly the same value of goods and services as we're importing, like if that's in balance, then it means things are going to be in balance domestically as well, right? And by imbalance, I mean that national income, everything we make domestically, will be equal to everything we're consuming domestically, right? So national income is going to, and you can sort of look at this right now. I've got this written sort of from the eyes of the individual kind of producer and consumer, right? So you can think about this like if the whole country was just one person, everything I make this year is going to be equal to everything I consume myself, everything I pay to the government, and everything I save for later, right? That'll be the sum total of like my personal balance sheet if I haven't borrowed anything from anybody or lent anything to anybody, right? So if I'm not exporting more than I'm importing, right, if that's balanced, and if I'm not borrowing and lending from the future, right, then everything I make this year, I can either consume it myself, I can pay it to the government, or I can save it for later. Those are like the three things I can do with what I make, right? So the other way of sort of looking at this though is if I am producing more than I am consuming here, then I'm going to be running this current account surplus where I'm shipping some of that excess production overseas, right? And conversely, if I'm consuming more than I'm making, it's because I'm bringing in some extra goods and services from overseas to consume, right? So if we have our current account totally in balance, then exports are balanced with imports. And if it's not balanced out, right, that's what we call a trade deficit or a trade surplus, right? And if taxes are balanced with spending, right, if those are perfectly balanced, right, then we are sort of running a government deficit of zero or a government surplus of zero. And if not, then we have a surplus or we have a deficit, right? If we're bringing in more in taxes than we're spending, we have a government surplus. If we're spending more than we bring in taxes, then we have a government deficit, which is what we have in the United States right now, right? And then it's private savings are going to balance, like domestic savings are going to balance with domestic investment, right? Because when you, as an individual, you have this excess production or excess income that then you saved in the bank, well, that bank is lending that right back out to somebody else who's investing it, right? Into a factory, into a house, into something like that, right? Okay. So savings are going to balance with investment. And if it doesn't, right, you're going to have a capital account surplus or deficit where you're either lending those excess savings abroad or you're borrowing from overseas to do that extra investing. Okay. So if we integrate these things, if we pull the exports and imports from the current account balance, and we pull in all these things from the domestic sort of economy, what we can do, we can rewrite a couple of these things. We can actually start down to the second one, which is exports minus imports. So this is the current account balance, is going to be equal to national income. Everything this is where we started with national income minus everything that we consume, that we invest, or that the government spends, right? That individuals spend, that businesses invest, or that the government spends, right? All of those things together are going to so national income minus all of that stuff is going to be equal to our current account but surplus or deficit. And so we can also write that as everything we make ourselves plus everything we bring in from overseas is equal to everything we consume, everything the government consumes, everything we invest, and everything we ship overseas. Right? So we can write these accounting identities several different ways. But what these identities allow us to see is how connected these things are. Right? That our ability to sort of export and import and our ability to lend overseas and borrow overseas is going to affect and be affected by the balance between how much we're producing domestically and how much we're consuming domestically. And these things are all tied together. So let's go talk about kind of how these things get tied together and how this works out. So I'm going to start with just a little bit of descriptive statistics on the US and China of this current account balance. Right? What does the US current account balance look like since 1960? You'll see in the 60s, we're running a current account surplus for a while, kind of on average running a surplus into the mid 70s. And it wasn't until really the 80s that we started to run a major current account deficit for a while, kind of bounced back up during the early 90s, and then where it really got low, right, where we were, so at this point we're importing a lot more than we're exporting, is kind of right around 2004, 2005, right? That's really the peak of this. And a lot of that, when we're running this huge current account deficit here, if the US is running a current account deficit, it means that somewhere in the world there are some other countries that are running a current account surplus. And a lot of our trade deficit was vis-a-vis China, right? So the scale is off on the x-axis here, but you'll see like that 2004 to 2005, when we're really peaking on our current account surplus, on our current account deficit, that's when China's really peaking on their current account surplus. So they're running a current account surplus, not just with the US, but also with Western Europe. And we are running a current account deficit, not just with China, but with a bunch of other countries as well. But there was a very large bilateral trade deficit and surplus between the US and China, where the US was importing a lot more goods and services from China than we were exporting to them during this time period. And then that got brought back into balance. And we'll talk about sort of what was going on with exchange rates to bring that back in closer into balance. We're still running a trade deficit vis-a-vis China, but a much smaller one than we used to be. So we'll talk about kind of the role of exchange rates in bringing current account deficits and surpluses back into balance. But let's start with, is a current account deficit good or is it bad? And a current account deficit, at least in the short run, is actually really fun, really enjoyable to be running a current account deficit. Because remember, what it means when you're running a current account deficit is that you are importing more stuff than you're exporting, and you get to consume more stuff than you make, right? So other people are sending you more goods and services than you're sending them. That's kind of nice, right? And I get to consume and even more than I'm making. That's really nice too. Essentially, you get to live beyond your means, right? When you're running a current account deficit, it means you're living beyond your means, which is in the near term is super fun. But as you might suspect, it can create long run problems, right? It's fun now, but kind of like running up a credit card debt, it has long term consequences, right? So when you are running a current account deficit, remember, that means you're running a capital account surplus. That means you're bringing in more foreign capital than you're lending out. So it means you're acquiring a lot of debt. And that's public debt, government debt, but it's also private debt, right? It's sort of the sum total of public and private debt is going to be significant. And if you generate too much debt, you're going to end up in a financial crisis, right? So it's fun, racking up debt is super fun while you're doing it. But you can have a financial crisis later that is super, super painful. So it's fun until it's not. So if you're running a current account deficit and you're worried like, hey, it's fun right now, but I think this might long-term be a bad idea. I need to get this under control so I don't have a financial crisis. How do you go about doing that? How do you go about bringing a current account deficit into balance, right? And moving toward a surplus, or at least reducing the size of that deficit. So if you have a fiat currency, which is to say that you have a currency that's not pegged to gold or anything like that, right? So the United States, the US dollar is a fiat currency. So is the Chinese currency. So is the euro. So is the Japanese yen. These are all fiat currencies. And so if you have this fiat currency, a tempting solution is just to manipulate the exchange rate, right? So to create inflation, to print money, right? And to deflate the value of your own currency, drive down the value of your own currency. Why does this help you with the current account deficit? Well, when you drive down the value of your own currency, at least in the near term, right, it means that the real cost of all your wages is going down, because wages are kind of sticky in the near term. So like all of your costs that you're paying for domestic inputs and domestic wages, right, in real terms, when your currency is becoming less valuable, then in real terms, those costs are becoming lower. So it's becoming cheaper to produce stuff domestically. And so your exports that you're selling overseas are becoming more competitive. They're becoming cheaper in other markets. So the other countries are buying more of your stuff. Now, conversely, when your citizens take these wages that they're getting in your deflated currency, so in real terms, they're making less money, right? And they go to try to spend that on imported goods. Those imports are super expensive for them in real terms. So your citizens buy less imported stuff because they can't afford it. So when you deflate the value of your currency, I'm sorry, when you inflate the value of your currency and decrease the value of your currency, right? So when you run inflation and you're driving down the value of your currency, right? Then at the same time that your exports are becoming more competitive and cheaper and other people are buying more overseas, at the same time, your citizens are buying less imports. So you're fixing your current account deficit from both directions when you manipulate your currency like this, right? Okay, so let's see how that works kind of in real terms. And we'll take, I told you that, to move from this situation in like 2004, 2005, where there was a huge trade imbalance between the US and China, and to bring that somewhat back into line, one of the things that the US did was that they pressured China to allow the value of their currency to appreciate, right? They allowed that China had been manipulating their currency, intervening in currency markets a lot to drive down the value of their currency to boost exports. This was a big part of their growth strategy, to raise exports, and so they'd been engaging in currency manipulation to do that. And we argued with them a lot diplomatically. The United States did, and pressured them a lot to allow the yuan to appreciate. And so that was what happened between 2007 and 2011. It went from a dollar being equal to almost 8 yuan to a dollar being only equal to about 6.5, right? So a pretty big move in these relative currencies. And so that means that, if you're trying to buy a dishwasher or refrigerator in the US that you're importing from China, that meant that in 2007, that appliance would cost $900. Few years later, the same appliance, that's costing China the same amount to produce is now costing the American consumer $1,100, right? So that means that those Chinese-made appliances are becoming a lot less competitive vis-a-vis American-made or appliances made in other countries, right? So we ended up importing quite, fewer appliances from China than we were previously because they'd gotten a lot more expensive. And on the flip side, if you look at some of the things that the U.S. was exporting to China, right? So if you look at machine tools that we were exporting to them, so a $25,000 machine tool, in 2007 that was going to cost close to 200,000 yuan, but it was down to more like 160,000 yuan a few years later. So the things that we were trying to export to them were getting a lot cheaper in real terms in China, so they were importing more from us. Right? So their stuff was getting more expensive in the US, so we bought less of it. Our stuff was getting cheaper over there, so they bought more of it, right? So that helped bring the trade imbalance back in line a little bit. I mean, we were still, at the end of this, in 2010, 2011, we were still exporting more to China than we were importing from them, but the imbalance was not as great as it had been. Okay, so that's one way to sort of bring a current account deficit back into line, is just to generate a bunch of inflation. And remember, generating inflation itself is super fun for a government. That just involves printing a bunch of money and spending it, right? Collecting a bunch of seigniorage. So if you've got a fiat currency and you can just inflate the value of your currency, that's super fun. And it allows you to fix your current account deficit. Yay. But if you can't do that, right? If you are, say, a country on the euro, and Germany doesn't want to inflate away the value of the euro because they hold a bunch of debt and they want people to pay them back in euros that are worth a lot and not euros that are worth a little. If you are not in control of your own exchange rate, or if you are a small country that has opted to use the dollar in order to make it easier to trade and borrow, then fixing a current account deficit can be really painful, right? So the other ways you can fix a current account deficit, right? So if we're looking at this equation, going back to this, so if we've got exports minus imports over here, we've got savings minus investment on here, and we've got taxes minus government consumption here. If this all is going to balance out, right, which is sort of by definition it's going to, then we think about, if we want to fix this piece, we can fix one of these two things, or we can either fix savings, investment, tax revenue, or government spending, right? We've got to fix something in here. So we can either boost savings, right, which means as individuals, of that money we've got, paycheck we've got coming in, we're spending less of that on consumption and we're saving more of that for the future. All right, well, that's painful. Cutting consumption is painful, right? We could have firms reduce their investment, right? So either consumers can sort of save more, which requires consumers spending less, or we can reduce investment, right? By firms. Firms could invest less, but that means in the long run we're going to have less capital per worker. We're going to have lower productivity, so that's going to harm economic growth in the long run. Less spending is going to hurt growth right now, and less investment is going to help hurt growth in the future. We could raise taxes. Oh, that's always pleasant, right? So raising taxes is going to disincentivize work and investment, which is going to yield less government, less spending by firms, right? And less spending by individuals, right? Okay, so this is painful. That's going to help drive us into a recession too. Or we could reduce government spending. Okay, that's also going to cause, drive us into a recession, right? We like to engage in countercyclical spending where, government spending helps stimulate the economy. So that's super painful too. So all four of these things that we can do to fix a current account deficit are quite painful. So it's fun just to print more of our currency, inflate away its value, and fix it sort of via exchange rates, which we call competitive devaluation. But if we can't do it that way, all these other options are rather unpleasant, right? So all these things reduce growth. And so that meant that, after the global financial crisis, when Germany was sitting there saying, no inflation, we're not going to inflate away our problems here. We're not going to engage in this competitive devaluation. That was really painful for a lot of highly indebted Eurozone countries, particularly in Southern Europe, who were running these big current account deficits and ended up having to do some very painful things to bring them back into line. While you're running a current account deficit, right? If you're running a current account deficit, it means you're running a capital account surplus, right? It means you're borrowing to cover your current kind of overspending, right? So borrowing money abroad to cover a current account deficit works as long as you can access foreign capital markets. And your other option, if you don't want to owe people money, right? The other way to sort of run a capital account surplus is to be selling off your assets to foreigners, right? So you can sell off real estate, you can sell off companies. So you're either giving people an IOU, right? When they're sending you a bunch of goods and services that you're going to consume, and you're not sending them nearly as many goods and services, you can either give them IOUs, promise to pay them later, or you can give them fixed assets. You can say, well, you're going to give me this stuff I'm going to consume, and now you own part of Rockefeller Center, or now you own, so chunks of real estate or American companies, right? So you can give them assets too. You can, and if you have a current account surplus, right, the flip side of this is that you're lending money to other countries, or using that surplus to buy assets in other countries. Okay. So this whole borrowing abroad situation, right, this only works for so long, right? Because you're racking up debt. And as that, both private and public debt. So both government debt and private citizens and companies are racking up debt, right? So this only is going to work for so long as the debt grows. Will or can the borrowing country repay, right? And investors may start to worry about that. So let's look at how kind of a high level of public and private indebtedness yields that financial crisis, right? So step one, sort of debt is growing, both sort of privately held and or government debt and in a particular country is growing. And questions start to arise about whether that country is willing or able to pay all that stuff back. And as people start to doubt that that country is going to be able to pay it all back, then investors start to get less willing to lend to both to citizens and firms in that country and also to that country's government, which means that those citizens and that government have to start paying higher interest rates for their loans, right? In order to get people to lend to them, they say, you look a little risky. You got to pay me, you got to pay a pretty high interest rate to cover my risk, right? Okay, so the interest rates start going up. Well, that means that on the debt you already have, you have higher interest rates, right? When you go to roll over your debt, if you had a 6-month or a 1-year or a 5-year loan and you need to roll that over, you need to take out a new loan to pay back the old loan. That new loan is going to be at a higher interest rate. So your interest payments keep going up, which makes that current account deficit even worse, right? And your debt rises even more, right? So this starts to snowball on you. So then more, as that debt is rising more, even more investors are pulling back, which means interest rates are rising even more, right? And this once this kicks off, this can be a really quickly accelerating spiral until you can't find anybody to lend to you anymore, right? And when you can't find anybody to lend to you anymore, that is when we say you are in a balance of payments crisis or a debt crisis, and they're pretty interchangeable. So you end up in a financial crisis, right? Okay. And our next lecture after this will be on financial crises. Surprise, surprise. Okay. Thanks so much for being with me. I look forward to talking about this with all of you in our synchronous session.